Real Estate and Mortgage Show, your go-to spot for everything home buying, selling, and financing on News Talk 580 CFRA.
Welcome to the show, everybody. Middle of November already, November 15th. Can you guys believe it?
It's going fast. Going fast, yeah.
Just like that. We're, 6 weeks away from the end of the year?
5 weeks away from
what?
Christmas.
From Christmas.
I always stress it this time of year, though, because I got to buy for so many people. I got staff. I got this.
Stop it. Petra's right now just laughing, saying you buy.
I do
the only thing that gets used is your credit card.
That's for
Okay,
certain.
you don't do any of the buying.
No, that's
okay, and I still believe, I think there should be something out there. The 24th of December should be a men-only shopping day. Just only men allowed in stores, because we're in and out in 2 minutes. We know what we want, get it, and get out.
Frank, speaking of my credit card with Petra, I'm on such first name basis with Amazon now that one day Amazon came and knocked on my door and they said, "Oh, we're just doing a wellness check because we don't have any packages for you today. We just want to make sure you guys were still alive."
Jeff Bezos is coming to your house personally to check on you?
Jeff and I are buddies, man. Jeff and I are buddies.
Petra just texted that the locks are being changed.
Oh, yeah. I wouldn't doubt it.
Right now.
Yeah, I wouldn't doubt it.
What a week. So, okay. We got all this snow on Sunday. What's it do to real estate activity for the week? Is it slowed right down, or does it matter?
Is it the snow, or is it the budget? Because I feel like October was booming. Especially for us, it was a great, great month. And then November, it's like the budget comes out, and it's just like...
You think it's the budget?
I don't know. Keep in mind, there's a lot of government workers that I've talked to that are just really nervous right now because of all the layoffs. And where do we live? In government land, right? So yeah, it could be the budget. It could be the snow, the weather, whatever it is. Let's be honest. November, December are not typically our powerful months anyways. But last November, we sold 60 homes. Right now, we're probably on pace for 45, 50, which is a down month for us. So yeah, it could be the weather. It could be the budget. I just think when the budget came out, it gave a lot more clarity to people.
But did it?
Well,
the budget didn't impact the everyday Canadian at all. Like, there was nothing in that budget that the everyday Canadian family said, wow, that's going to help. None of that came out. It was more about future. It feels like, okay, here's the investments that we need in our country, and this is what we're going to focus on, but it's 3, 4, 5 years away. They didn't say that, but essentially that's what happens when you focus your budget on those types of measures. So,
well, you even said this last week too, Frank. You said, with these job losses coming in the government, we've been sort of hearing about this since the election happened, and so everyone's been nervous. The budget comes out. Okay, now we know these cuts are happening, but you said it even last week, over the next 3 years. So they're still nervous for the next 3 years about who's getting cut and who's not. So I don't know. It's going to. I think it could impact the real estate market. I know different economists and different people are saying the market next year should be strong. I know the Canadian market as a whole is not strong right now. Ontario is not strong right now, mainly based because of Toronto. But who knows? They are saying 2026 could be a strong year, a stronger year. But then we talk about all the people coming up, their mortgages are renewing in 26 and 27, and what's going to happen there. So it's kind of like I feel like Ottawa, since the start of COVID, has been a very strange market. It's hard to predict. It's
gotten much more difficult to predict.
It really is, and that's why I'm working so hard with our agents, Greg, just basically saying, guys, like, we got to get better. We have to have better skills, better this. AI, like we're working on AI like crazy. Like, you have to adapt because things are obviously changing at a rapid pace, but the market's tough. It's a tough market, which is not a bad thing because it allows people like you and I, Frank, to actually, when you're at the top of your game, you're usually okay, but we still have to sharpen our skills and get better and change and adapt and bring in more programs, procedures, and things like that. So it makes us sharpen our skills, which is maybe not a bad thing.
Yeah, and I'm going to say this about the real estate market. I think that it could go one of two ways, and I know that Ottawa is typically a very secure and balanced neighborhood, but I'll say this. I think there's lots of Canadians out there that have their mortgage coming up for maturity, and obviously their interest rate's going to go up significantly, and some of them want to do some upgrades to the house. So I've had quite a number of people, and this concerns me. These are the headwinds that the real estate industry, I think, is facing. is that they looked at it and they said, we'd rather borrow $50,000 in equity to fix our house the way it is right now and get that new kitchen, get some of the flooring and bathrooms done, than buy another one that maybe the work is already done on it, because the cost of the real estate commission, the cost of the land transfer tax, the cost of is way more than it would just cost us to renovate the house that we're in. We don't have to pack. We don't have to move. So I've had 2 or 3 customers say that to me. Now, again, if you're in a certain neighborhood and you love your neighborhood, makes total sense. But before COVID, I would say that people would be more open to selling their house and buying another one and absorbing those costs. But land transfer tax would have been on the average house value of $400,000 or $500,000. Now that you're looking at $700,000 or $800,000 or $900,000, that land transfer tax is up significantly, and people are starting to do the math on it and saying, I wonder if it's worth doing it now. I wonder if it makes more sense for us just to stay here and renovate our house. So that's part of the headwinds I think that the real estate industry is facing, as well as, you said, the federal layoffs, the federal government layoffs. But what a lot of people forget is that if federal government lays off a lot of people here in Ottawa, other jobs are going to be impacted by it too. Because if you're laying off that many people, that means expenditures are down for a lot of families. And once they're not spending money, that means other jobs are going to be lost, whether it's in the service industry, the travel industry, but there's going to be other jobs that
certainly
get lost
there's a domino effect that goes along with that.
And I think the service industry and the travel industry is already impacted. I mean, there's people who aren't spending as much money on restaurants and traveling and things like that. I mean, have you seen the cost of flights these days? It's not cheap. It's not cheap. I mean, gas is not cheap. Things are not cheap. So, but I still think we're going to have. I mean, we're in Ottawa. We have a strong. I've said it before. We've gone down 4 times since 1956. Our average sale price. It's not going to go down this year. We're going to be probably 3.5% up. I think we're going to have a decent year again next year. But we're back to our typical Ottawa market. You know, anywhere from 2 to 5% increase in the average sale price, which is a normal market. Which is, you know, as long as your market's going up, that's great. I mean, when I was at this conference a couple weeks ago in San Diego, there was a lot of these American markets that are like, you know, oh, we're up 10% this year. Oh, but we're down 12% next year. And like, it's just, their markets are more fickle. And it's almost like the stock market. You almost got to try time it, right? When's the time it's going to go up? We're here in Ottawa, you know, when you buy a house, there's a very good chance in the next couple of years you've increased the value of your home. Very good chance. If
2 to 5%.
Exactly. So it's a very good chance. So,
we do see those examples like you were mentioning in the States as close as Toronto.
Toronto,
Vancouver have those massive swings.
I wouldn't want to be in a market like that though, because you never know if you're buying at the right time. And whereas in this Ottawa market, you know you're buying in the right time. Whereas in Toronto, it's like, you know, did I get my house for the right price, or is it going to be worth $50,000 less tomorrow? You know,
right?
And their prices are insane. Like their Toronto prices are insane.
It's the condos that are really being impacted in Toronto. And I was in Toronto on Wednesday for a conference, and Ben Rabideau, who I'm trying to get on our show to talk with some of our listeners for sure, and give his insights, and he's willing to do it soon. So, but anyway, he talked about the Toronto condo market, how there's such a significant shift in the condo market right now, and he feels for the next 3, 4, 5 years that shift is definitely there, where, you know, somebody who bought a new build condo at $750,000 now is trying to get rid of it at $600,000, $550,000. They've got to absorb huge losses. But he also feels that in time that's going to catch up, and eventually we're going to get back to where it was 5 years ago, where people are going to drive the prices of condos up. So it's a matter of timing as far as he's concerned.
Well, supply and demand too,
right? It is.
I mean, if there's no supply right now, because there's something like 3,000 or 4,000 condo buildings, units that stopped building this year. They had their permits all ready to go, shovels getting ready in the ground. They couldn't build. So they couldn't get the pre-sales. So there's like 3,000 or 4,000 units that were not built, that were scheduled to be built. What happens in 3 to 4 years when those should have been built, and there's people looking for homes, and now there's less inventory than there should be on the market? It's going to drive up the prices. So eventually the prices of those condos in Toronto are going to skyrocket. They're going to, because they won't have enough supply.
But they just can't seem to get out of this roller coaster ride of prices high, prices low, prices high, prices low. Why is it
in
just
Toronto?
Yeah.
It's basically in Toronto. I mean, we see it here, but I think at a much smaller scale in Ottawa, because we don't have the number of condos in Ottawa that they do there in Toronto. And you really notice it in Toronto, Vancouver. Vancouver is experiencing the exact same thing. Empty condos sitting everywhere. And And the rents are still way too high, and that's the other problem too is, if you want to keep those as investment properties, the rents are significantly higher than they should be, and people can't afford to rent that. Most people can't afford a 700 square foot condo and pay $3,000 a month. Like, the math just doesn't add up.
Plus condo fees, plus utilities. Yeah.
Well, it's $3,000 a month because the owner's got to pay for the condo fees and everything
mortgage,
that goes with
yeah.
it.
So we had a mini version of that in Ottawa, probably 7 years ago. We had about 20, maybe 5, 6, 7,
2017, 18,
something like that. We had about 2,300 condos on the market at the time, and that was awful years because I literally have to go see a seller and say, I know you bought it for 700, but it's actually only worth 6 now. Like, those were tough conversations. And what was happening is people were forecasting, buying all these condos. The buildings were done, and then people tried to get out of them. There's like 15 for sale, and like, oh, I can't sell them, so now I'll put it for rent. So now they have 15 for rent, and it was driving down rent prices, and it was just a really tough condo market back in that. I think it was like 2015, 16, 17, something in that range.
Well, and as Frank was saying earlier, like with the budget and a lot of the government incentives coming out, like $25 billion in incentives, but that's going to take years to roll out. Like that doesn't get to helping people now. I mean, I understand we have to think forward and help people in the future, but
that's the argument right now is that whatever they put in place, and listen, the PST and HST rebates for first-time home buyers on new builds is great. But if the interest rates stay where they are and if the cost of a home stays where it is, it's still unaffordable for first-time buyers to get into a home like it was 5, 6, 7 years ago. We've got a ways to go. And the only way potentially to solve that, in my opinion, is either we have significant increases in pays, which I don't see happening because, as AI starts to take away jobs, there's no reason for salaries to go up tremendously. So I don't see that happening. So then the other alternative, and they're talking about it in the U.S. In the U.S., they're talking about increasing amortization from 30 to 50 years.
50 years.
Right?
Oh.
So what's wrong with ours going from 30 to 35 or 40 years? And, we had a 40-year amortization during the financial crisis, and they took it away because for some reason they didn't want houses being used as ATMs. And I think that's just a bad way of looking at it. I think that houses aren't ATMs. Houses are places where you actually build your family, you live. So
that's most people's retirement.
Build some wealth.
Yeah. So we can either encourage it or we can discourage it. And I think this government chose to discourage home ownership. Now, again, I think a big reason behind it is the fact that they weren't building them fast enough and there was more people looking to buy homes. So you've got that supply and demand issue. But if they can get their act straight and start building homes to match the amount of people that we have, then going with a 35 or 40-year amortization will do two things. Number one, it'll drive the economy. It'll help the economy. And number two, it'll give those first-time home buyers or even older people that have been renting forever now have an opportunity to get into a home and have a reasonable payment that's comparable to rent, but have a home ownership instead. I mean, there's nothing wrong with that because you want to be able to give Canadians the opportunity to be able to create some wealth moving forward.
Have a question, head over to realestateandmortgageshow.com and submit it there, or give us a call at 521-TALK, 521-8255. We will be right back. Welcome back to the show. So just before the break, Frank, we were talking about increased amortization. Is there a possibility? I know we've just got to that 30-year for everybody.
We got there for a bit, and I think the 35 and the 40, and I've heard it kind of talked about here and there, but I don't think it's seriously on their agenda right now. But it could be if they start to see that. And I think the big question, and we're going to see it now, I think over the next 18 months, I think, in 2026, we've got mortgages maturing from 2021. So you're going to have a lot of Canadians going from, and we're talking to them right now. They're at 169, 179, and now they're having to renew with 379, 389. And it's not double the payment, but it's significant enough that it impacts their everyday lifestyle. So, when your payment goes up $400, $500, $600, it has an impact.
Especially if you're living paycheck to paycheck,
and a lot of Canadians are. According
to stats, a lot of Canadians are. So when you look at those numbers, you start to worry a little bit about it's going to impact our economy eventually. It may not happen right away. And like you do, Paul, if I go to a restaurant, I notice that on weekends, restaurants are they're busy. They're fairly busy. But you go now on a Monday, Tuesday, Wednesday. I mean, after COVID, I think a lot of people had discretionary spending, and they were busy on Monday, Tuesday, Wednesday, Thursday. You go to restaurants now on Monday, Tuesday, Wednesday, Thursday, it's significantly different. It's not so busy anymore. It's fairly quiet. And
well prices, though,
it's crazy.
I'm a foodie. I spend money on going out for food. I love going out and going on date nights and that. So I'm the extreme, but they've got way more expensive. Like now, if you go out and you have a drink, maybe a bottle of wine or a glass of wine with your dinner, and you have, a meal, you're not walking away in anything less than a few $100. Like, you're just not. It's super expensive nowadays to eat.
You got to do what the kids do now. Like, they pre-drink. You know what? Before you go to dinner, you got to pre-drink at home. I don't go
to the dinner to get drunk, Frank. I go to
no. But pre-drink from a standpoint of have a couple of glasses of wine, and then you don't necessarily have to have it with your wine. Because you're absolutely right. I mean, a bottle of wine,
$75 minimum,
$80, but it's that same bottle that's $12.95 at the LCBO.
I know, it's
and
crazy.
you start to ask yourself, wait a second.
Yeah.
Okay, that seems a little crazy now. And by the time you put the tip and the tax in there, it's a lot. So I think you're going to start to see people pull back from that. And again, that costs jobs. That hurts the economy.
Sure.
On top of that, I think that there's a lot of Canadians that need to keep their payments similar. So now they have to reamortize their mortgage. And here's what I find is extremely disturbing to me is that banks and lenders, if you want to increase your amortization, there are certain circumstances that we could do it. So, and I'll talk about that in a second. But most banks will treat it as a refinance, while the refinance rates are significantly higher than just renewing your mortgage as it is.
At the 379 or 389.
So, in other words, they can offer you 379 if you just renew your mortgage the way it is.
Sign the
Same
papers.
Amortization, initial here, sign here, you're done.
Right.
What if I want to increase my amortization to 25 or 30 years because I can't make ends meet? Well, now it's a refinance. No different. Everything, same amount. You're not borrowing any more money, but it's a refinance because you want to increase the amortization. It needs to be re-registered if it's a standard mortgage. And therefore, now potentially an appraisal is needed. Legal fees are needed. And the interest rate goes from 379 to 429. That's what's unfair. Yes.
That much of a
difference. So that's what's unfair. I've even had clients say, Frank, I've got a mortgage and a home equity line of credit. I asked, so my mortgage coming up for renewal, they offer me this rate. I've got my home equity line of credit. I say, you know what? I might as well lock it in. I'm not going to be able to pay it off, and I'm paying prime plus a half on it. If I can get a variable at prime, they're offering me prime minus 70 on a variable. Why not do the same thing on the home equity line of credit? They come back and they say, nope.
That's
on the home equity line of credit, you can only get prime minus a half. That's the kind of stuff that the banks are doing to Canadians, which I think is totally unfair and not regulated, so therefore they can do whatever they want because nobody can tell them they can do any differently. So I will say this, though. If you have what's called a collateral mortgage, so a collateral mortgage is basically a mortgage with typically every single major bank. If you wanted to just renew it and increase your amortization, because it's a collateral mortgage, so the difference between a collateral and a standard mortgage, a collateral mortgage doesn't have an expiry date when it's registered. So it has no expiry date on registration. Standard mortgage, if you took a 25-year amortization, expires at 25 years.
25 years.
Expires
Makes
at 25
sense.
years. So therefore, if you increase your amortization, it makes sense for the lender to have to re-register because otherwise you're above. You've got more years left than when it's going to fall off the registration. So they have to re-register. That makes sense. But on a collateral, there's none. But even though banks realize and know that you've got a collateral mortgage, they still charge you to re-register the mortgage, which is totally unfair. So through a mortgage broker, we have lenders that if you have a collateral mortgage, you can switch it over to another lender. And because it's a collateral mortgage, it doesn't cost you anything to do it. And you can increase the amortization and still get the better rates. So again, Canadians just don't do their homework on this kind of stuff. And, my recommendation is always get that second, third opinion and not necessarily all from the banks. Try a mortgage broker. See what's available through a mortgage broker. And when customers say to me, yeah, but I never heard of that lender, I'm not comfortable with it, I want to tell you that likely behind that lender is one of the big five banks that's lending that money out.
You've said that
anyway.
many, many times. The big banks finance all of the smaller lenders.
More or less. Is there equity funds in there too? Of course there are. But
sure.
When people say, Frank, I'm nervous. What if they shut down? It's like, are you kidding me? If they disappeared and they forgot about your mortgage, would that be such a bad thing?
Yeah, exactly.
That wouldn't be such a bad thing.
Listen, if they disappear, someone absorbing them, someone's buying them, right?
They're not 100%. Somebody's buying that book.
They're not just falling apart.
No, exactly.
I question what's going to happen to the real estate market in 2026 and 2027 with all these mortgages coming up for renewal if we're going to see people having to downsize. But
Right.
I think the only good news is they've built up a lot of equity because, their value of their homes.
26, yes.
26, yeah. 27's a different story because that was when we really started to see the slide in 2022, right? Let's start at 2022. April was our peak. After that, we've sort of come downhill a little bit. So for those people who are renewing at the start of 2027, might be an ugly story. That might be an ugly story, might be a little bit cautious. 2026, I don't think is going to be as bad. But with the way Canadians are now living paycheck to paycheck, you get an increase of, a couple $100, $300, $400 on your mortgage. And that's not chicken feed. That's big dollars. And especially when you're living paycheck to paycheck. So let's hope that, they've been able to get their mortgage down a little bit. They do have some equity.
Some of that equity built in. So it's not going to be too painful for them when they do have to renew. But we may see some people having to downsize. We may see people having to sell and get a smaller property or a cheaper property. But then again, what are the prices going to be like when they go to do that? Absolutely.
You never know.
Have a question? Head over to realestateandmortgageshow.com and send us your question there. Or give us a call, 521-TALK, 521-8255. We will be right back.